When you go to an exam, in that exam, the maximum marks are let's say 100. The passing marks are 40. What do you aspire for? Do you aspire to pass, or do you aspire, to do extremely well? Well, some may, like to just pass. In RBI, we like to we like to be on top of everything.
Well, the Reserve Bank governor clearly was on top of his job. While announcing the 0.25% rate cut by the MPC, the governor didn't overpromise on any count. He didn't indicate continued dovishness, nor did he signal a surfeit of liquidity, just appropriate liquidity. So the question is the policy statement too restrained in its dovishness? The GDP forecast for next year, FY26, is at 6.7%, inflation at 4.2%. Is this too ambitious? Both inflation too low and growth a bit too high. The regulations on LCR, that is liquidity coverage ratio, and on expected credit loss, ECL accounting, have been postponed. But the higher risk weights on loans to NBFCs and unsecured borrowers has not been reduced. Is the RBI still too restrictive on credit? Well, to answer all these questions, I have with me an elite panel. Mr. C.S. Sethi, the chairman of the largest bank, the SBI chairman. Mridul Sagar, former member of the MPC and former ED of the Reserve Bank, now professor at IIM Kozhikode. B. Prasanna, the head of Global Treasury, Global Markets at ICICI Bank, and Samiran Chakrabarti, chief economist, Citi India. Gentlemen, thank you very much indeed for your time. Mr. Sethi, I'm aware that you are in a hurry, so I'll rush the first questions to you. The big point is there is a rate cut, and that will obviously get transferred to loans that are linked to the repo. But when will the first deposit rate cut come for the system, you think, considering that the RBI has also promised appropriate liquidity?
Yeah, thank you, Lata, for having me on your show. It's always a privilege. I think the loans, of course, will repo-linked loans, particularly EBL, are what we call, get repriced immediately. The liquidity measures what RBI has taken definitely improve the system liquidity. And the governor has also promised that he will ensure the durable liquidity. So which means that today, as we speak, while the situation has improved, it is still not in the positive territory. Still the deficit is there. And but a lot of effort on the part of the RBI to ensure sufficient liquidity availability reduces the concerns on the liquidity. Then the deposits, I think it will take a while. Maybe not in the current quarter. I don't think any banks will immediately cut the rates. Even if we, going forward, will cut the rates, there is a significant time lag in terms of repricing the deposits. Yes. Because most of the time, what we have seen in the recent times, people wanted to lock in the rates. So the largest growth of fixed deposits happened in the 1 to 2 year category, which means it takes some time for the deposits to get repriced.
Okay.
But the new deposits...
No, your incremental, yeah. New deposits, when do you think it will take a quarter to announce a lower rate?
I think this quarter being, Q4 is generally a busy quarter for everyone. Most of the banks would like to push the credit growth also is significant. So obviously at this time, everybody wants to raise the deposits also. Okay. My assessment is that the immediate rate cut on the deposits across the banking system may not happen. Some banks may choose to cut the rates, but not definitely across the banking system.
Okay. What about growth of credit, sir? There were two green signals, I thought, from the governor saying that he's happy with the credit deposit ratio or something to that effect. And on the other side, the counter being that they have not reduced risk weights on anything. So do you think credit growth will start overtaking deposit growth quickly? I mean, it is overtaken in your bank. I mean for the system.
For the system, The narrative from the central bank also seems to be in tune with what government budgetary proposals have been, particularly the credit flow to the MSMEs and agriculture. So I'm sure the governor probably had in mind when he spoke about, the comfortable CD ratio, and even if credit growth happens in these two segments, maybe the central bank will be happy about that, because these are the two sectors which definitely needed to be supported, and from both in terms of job creation and job maintenance. So my view is that the sufficient liquidity will also ensure that the ability of the banks to fund will improve.
Yeah.
So
No, I mean, we are very crucially dependent on this credit growth, because at one point in time, credit growth was actually lower than nominal GDP. Only if credit growth is fueled and goes way above the nominal GDP, like goes to 11-12%, will we start getting economic growth? Can we be confident of growth? That's why I'm trying to pin you down on whether you see credit growth growing and by when.
Credit definitely will grow. I think our overemphasis on unsecured personal loans growth in the system probably overshadowed, the credit flow to other sectors.
Okay.
Now, definitely, with a lot of measures which have been taken in terms of MSME lending, the corporate credit growth will be moderate for some more time. I think we'll have to see how the demand, consumption demand, which is going to be spurred by the budgetary proposals, will it make private capex to pick up, and then they will also start borrowing, is something what we have to be, on the lookout for.
Okay.
But I believe that there is a good growth potential for credit, definitely in the current quarter.
Okay. Well, the hope, of course, for the whole world, I mean, stock market investors as well as corporate sector, is looking for growth, and their liquidity and credit offtake are the two things. And both these are something bankers are in a better position to assess. Finally, Mr. Sethi, what about margins? I mean, here you have to talk only from your angle. Does it impact only a little because only repo-linked loans get priced lower, and you're saying it will take at least a quarter for the first cost of your raw material to fall, deposits. So margins will be under pressure for a couple of quarters for banks?
In our portfolio, of course, we have limited EBLR linked portfolio is about 29%. So the impact of this rate cut of 25 basis point will not have major movement in the NIMs. Even if on an annualized basis also, I don't think if the rate cuts become more frequent and deeper, then we'll have to see. Obviously, the deposits also will get, some transmission will happen on the deposit rates also. But this rate cut is not going to significantly impact SBI in particular, even in the banking system in general.
Okay. Finally, sir, before I let you go, any other takeaways that you found from the policy?
I saw a lot of takeaway from your shows from the morning, Lata. Definitely, I think the intent of the central bank seems to be, growth oriented, and there are a lot of nuances in the governor's speech and the press interaction. And one of the overhangs in terms of the policy in regard to LCR being removed, I think definitely it's a positive for the banking industry.
Oh, yes. I expected that bankers are extremely thrilled with not having to lock up liquidity, at least for the next 1 year. Mr. Sethi, pleasure having you with us. Thank you very much for making time for us. And I'm glad your flight landed on time and we could have you on the show. Thank you for joining us, sir.
Thanks.
Okay, let's now parse the policy in terms of economic and market impact. And we have our experts with us. Prasanna, to start with you, the yield went up actually by 1 basis point, the 10-year yield. You have got a rate cut and you go up from, I think at one point it was even 6.65 and then went up to 6.7 by the time it ended. Why? What did the market take away?
So I think, Lata, there are two or three things. One is the fact that the market had already kind of expected the repo rate cut. And there were sections of the market which was also expecting a change in stance, which didn't come through. And there were also people who were expecting further liquidity measures as a follow-up of what they had already announced in the previous 15, 20 days. So some of them didn't come. The change in stance and further liquidity measures didn't come. And that was two reasons why market took it negatively. But more importantly, I would say that the fact that what is really actually good for the real economy could have been bad for bond markets today. And I'm referring to the LCR norms, because there was some level of expectations that if the new LCR guideline were impacted, it would have been positive for the bond market because of the incremental 4 to 5 lakh crores of demand in the next year coming in from for HQLA assets coming in from the banking system. So if you remember, when the draft guideline came in, there was around 4 to 5 basis points of rally when that happened. So I guess some of it is just payback of that and giveaway of what rally which actually took place at that time. But the yields going up today, I would presume, has nothing to do with the stance of the policy, what the governor has spoken, what the policy has done. I think it's a great policy. And I think there are a lot of nuances which we can possibly discuss over the next 15, 20 minutes. But I think there are some positives for the bond markets as well. And they will come to, react to this over the period of time. Of course, always the global uncertainties remain, and we have to always, take that into account.
Keep that in mind. Absolutely, absolutely. Samiran, would you say the RBI is being a little too ambitious at 6.7%? We are heading into a very difficult geopolitical situation.
So, Lata, our sense is that we have to think about growth from a more holistic perspective. First, to start with, the December quarter GDP growth is already probably up to about 6% odd. So the path to traverse from here to that 6.7 is not too far. And we have had at least three different things going in our favor. One is that at central government level, the public capex for FY25 itself has got accelerated quite significantly. The expectation is that for the Jan-March quarter, it would be 21% year over year if the revised estimate targets have to be met. Second is obviously the income tax cut announcement in the budget, which can spur consumption activity in the short term. And third is the overall package that the RBI has put in today with rate cut as well as promise for better liquidity and a more pragmatic approach towards macroprudential measures. So this whole policy nudge, both from the fiscal and monetary policy side, we think is good enough to push us up to that sort of a number. Our own forecast was even before the policy at 6.6, which is not too different from the RBI's forecast. So that way, I'm quite comfortable that we are on the right track on growth.
Okay. Well, I heard a large number of economists who are at 6.5 at best or south of it. But yes, you told me 6.6, and I think ISEC PD has 6.8. So there are some people who are willing to, bet on a better growth. Mridul Sagar, I wanted to ask you, what do you make of the governor's statements on liquidity? I personally asked him that the rate cuts will not get passed on unless you keep surplus liquidity. So what did you make? Will they keep it surplus, or was he shy of promising and stopped at appropriate and not ample liquidity?
Lata, we have to recognize that market expectations were running ahead of what was feasible and what was desirable in this policy. And I think the governor rightly chose to temper that expectations, because it's very important to calibrate things and not commit too much forward, especially when you have high uncertainty. So from that angle, I think we have to read his liquidity statement with some nuances, in the sense that it's not that he's saying I will flush the market as the market expects. Neither is saying I would commit the same mistake what had happened over the previous quarter of very tight liquidity, which came on the back of forex interventions and stuff. So you have to see that the reserve money growth this year has been very dismal. At 3.5% year on year, I think this is something which one reminds of the Great Depression mistake of the Fed, where basically the monetary policy was kept too tight to defend the dollar. So as we go forward, they can use FX buy-sell swaps. They can do open market outright sales.
And that's exactly why I'm asking, Mridul, why not promise surplus liquidity? Why only stop at appropriate?
So appropriate doesn't mean that you are in deficit necessarily. So appropriate is that you're not flushing the market as you're actually doing so in times of, say, extraordinary crisis like the global financial crisis or the pandemic. So he has said he will be proactive and he will look into it.
Okay, so you think...
I say open market bond purchases he'll make, and then he will obviously add to the liquidity as it may be required. We have to be cautious. See, if you have a more 2 trillion coming in form of RBI profit transfer surplus and the government spending pickups, you can make mistakes on the other side.
Okay. So yeah, especially when the rupee is, especially when, speculators may use the cheap money to short the rupee. Fair point. So the governor's appropriateness is better than being ample in his liquidity promise. We have to take a quick break, but lots of questions on, the new instruments that he has given on, what are you expecting in terms of the next rate cuts? All that coming in a jiffy after this break.